Hey guys, welcome to another Trade Genius podcast. Bob and Phil here as always. Today, markets were down, very red, and that was just the first shot across the bow. And if you guys have been listening to us, this shouldn't come as a surprise to you. But guess what? Probably not going to be a quick recovery here. More to come. So let's dive in.
Trade Genius.
Hey guys, I want to tell you something that we do that really will change the way in which you look at trading and also absolutely help you increase your profitability and how much money you make. It's the Trade Genius newsletter. We put the newsletter out Sunday night through Thursday night, and this really looks at the plumbing of the markets and helps prepare you for the next trading day and help you make money. And we give you a lot of information. We give you market statistics, we give you market levels, we give you the seasonality, what's happening with different sectors of the market, and we will help you identify whether the market's in a bear mode or a bull mode, or whether it's euphoric, whether it's despondent, and it just puts you in a position to be on the right side of the trade. So take advantage of our offer that we have below, and you'll love it. I mean, one trade that you make with this thing can pay for definitely a month, maybe even a year's worth of service. It's that powerful. Use promo code podcast for 15% off the retail price of newsletter. Thanks for listening.
Bob, what do you think today? A pretty red day across the board.
Yeah, and I know you're going to go into the particulars of that. I just want to keep emphasizing for people that think this might be a kind of a V kind of bound short-term thing off to bull market land. And really what's driving this whole narrative is really the M2. And really we're flipping from an inflation model to a deflation model. And I want to throw the first chart up here just to show you what it looks like. Okay, basically collapsing M2 is collapsing velocity. And what velocity simply means is how fast money's moving in and out of my pocket around the economy. And so it all starts with how much money supply is being generated. And that money supply then gets multiplied by how fast it moves. Both are falling, Phil. And as you can see, the CPI, which we've all been scared to death about, the end of the dollar, we're going into inflation forever. All those things are likely to happen at some point, but it looks like deflation's going to win. Powell is going to get his wish here, Phil, and we're going to get a whiff of deflation here, and hopefully it's just an appetizer. The second chart I want to show you kind of emphasizes how much farther we have to go from a macro standpoint. Now, this is a really cool chart. It's basically the M2 divided by GDP, okay, and it's looking at it's pushed out a year. So what it's telling us is that the market follows the M2 and the GDP growth of the country. And as you can see, that line, which is like light magenta on the screen there, has fallen off a cliff, yet the market has not yet followed it to the extent that it needs to. So my personal view is that probably we're going to get a leg down here for the next 4 to 6 weeks in general. We're going to get a lift, and then I think we're going to get that follow through again into the fall, Phil, because the political environment is not conducive to stimulus, and the monetary environment is absolutely not, because Powell's still in QT mode. So before I jump, I'm going to show one more chart if you don't mind, and I'll let you jump in on some comments. Is that here's a really interesting chart, kind of blew me away. I thought it'd be cool to share it. This is M2 and charge-offs of credit cards. Look at the credit card charge-off rate. What it's basically telling you is that you can charge me whatever interest rate you want, but I'm simply not going to pay my credit card bills.
Yeah, that's pretty telling.
And that usually coincides with recession.
Yeah, that jumps out at me a lot. And I think that's probably why, too, when we look around, we say, well, people are still spending money on things. And I think we're so over leveraged here on credit, and I think everybody is trying to sustain a lifestyle. A lot of people will try to continue a lifestyle that they no longer can afford. I was listening to some of those economic talk shows where people call in, and the financial counselors talking to them. And we're talking about people, they're not stupid. I mean, they're making, household income of like, $250,000 a year between the couple, but they got like 130 grand racked up in debt. whether it's credit cards or car loans, you know what I mean? They're not being like fiscally conservative. And they even admit like, hey, you know, we've been racking up credit cards trying to live this life. And always across the board, it's like, well, you're gonna have to suck it up now. You're gonna have to stop spending the money. And I think that's largely why we see retail sales and things like that haven't really fallen off the cliff yet. But I think that's coming. I think people are finally gonna get to the point where they're gonna have to tap out and their credit card expenditures is no longer sustainable. One thing that we can start going back to looking at charts here, I found this also very eye-opening. It's the percentage of stocks that outperform the 20-day moving average on the S&P 500, okay? It's at all-time lows. We're talking like back in the tech crash, 2000s, all right? And this is even smoking the COVID lows and even more so smoking the big crash of the great financial crisis. That tells you the breadth is so horrible here and the performance is so horrible that really what's been propping up this market is just a few select stocks, really. That's it. And you don't have a broad market rally here, which means that the drops can be quite severe. The other thing that jumped out at me was this chart. This is a 10-year Treasury constant maturity minus the 3-month Treasury constant maturity. This is basically another look at what we are constantly pointing out as an inverted yield curve. But as you can see, even this is down to levels that we have not seen before. And what this part of this is compounding the issue of the debt ceiling not being raised. And I think this is telling us that this debt ceiling battle is not like the others. This is the bond market now, and the bond market is usually the smartest one in the room. So it sees a significant issue with the debt ceiling, whether it's going to be that we hit our X date sooner rather than later. The X date means that we absolutely can't run the country, or at least the government. Non-essential things will have to get shut down immediately. National parks, things of that nature. And that could happen sooner than later. Maybe that happens in May instead of June. The point is that the bond market's really bracing for impact there, and it's going to have a negative effect on equities. The other thing I'd leave you guys with is just basically where we're at in the market. And we've been warning about this now that we were coming up to this point. And you guys can see here with a risk off fire, we talked about that last week, and now we're breaking that trend line. And the way that the algos and the market participants have been running this market is we get these pretty good up channels. You can draw a pretty consistent trend line on it. And then when we get that trend line break, we get our 4 or 5% or more drop. Obviously back here, August of last year was a huge drop. And I think we're playing with fire. We could get one of these situations where we drop and we pop a little bit, but then when we start getting into, I think we're kind of in between this phase here where you could get an initial drop, you'll get a pop and think everything's okay, and then that debt ceiling issue starts to rear its ugly head, and then you get big follow through to the downside. In any case, I think all of these prior lows down here at 3,800 to 37 and change, I think those are all at big risks. And then obviously the big one is going to be last year's low down below 3,500, which my feeling is that eventually we're going to get down there sooner or later before the end of the year. So, but you can see here, we got our big break on the trend line. Normally when you get that set up off of a trend line and a big daily bar like that, you're going to get a day or two of follow through, similar to what we saw here. We could gap down tomorrow. You see it here, you break and you gap down. This one had a rally back up. We could certainly see that, but usually we're not reclaiming the trend line and then we have more follow through. Here you can see we have the break, right? And then a gap down. So if we didn't get a gap down tomorrow, it would be kind of surprising, but that's been kind of the modus operandi here with these markets when they break down, Bob.
Yeah, no, I totally agree. And we've been typically on this 40-day cycle too, Phil. When you break these trend lines, you tend to get follow through at least 4 to 6 weeks to the downside and to the upside. And so I'm looking for, probably some weakness into the first or the second week of June, which ties to seasonality too.
Yep. Yeah.
Yeah. So, guys, I'm telling you, we're not out of the woods yet. And the political environment, like I said, is poisonous. Geopolitical environment is not helpful. Europe's a basket case. And the BRICS aren't big enough to do anything meaningful for the world economy, even if they could. So I think we're going to be in some general malaise here. Be very cautious here, and opportunities on the short side. We had a great day in the room.
We had a great day in the room because we were all positioned off this risk off signal, basically. So, and this package I think will be out May 1st or something like that, Bob. So look for this to be out on our website. You guys can pick this up and you guys can run this template yourself. So anyway, that's all I had, Bob, today.
Hey guys, hit the like, notify, subscribe, send us an email. You get a lot of good information for free. Take advantage of it, make some money here. Don't be a victim here. You can make a lot of money in this environment.
So guys, thanks for watching. Please hit like and subscribe. And again, even though we have volatility incoming, you can profit from it. If you're curious, you can join us in the rooms. Just head over to tradegenius.co or even check out our newsletter because that guides you through the market day after day during the week. Otherwise, as Bob likes to say, buckle up, Buttercup. We'll see you on the next video. Take care.
Trade Genius.